Yes!
It's a good day to jump into the butterfly.
The more power you have.
Watch what the mark does.
Is that a support area? This is the Trader Talent Show.
The markets usually are going up.
We talked about T+0 line lift. Wonderful. But I don't really want to be in that trade.
That sea of death right there.
Volatility is through the frickin' roof.
Hey, welcome everybody to our Ultimate Income Trader Informational webinar. Before we get going, we would just like to first remind you that this presentation is for educational purposes only. We're not broker-dealers or financial advisors, not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and be sure you are aware of all your risks prior to placing any trades. Also note that we may be using hypothetical computer-simulated trades. If we do, they are believed to be as accurately represented as possible, keeping in mind that live results can vary significantly from hypothetical for many different reasons. Everything we're doing today would be hypothetical, by the way. Okay, so let's just kind of move forward. Today, Stephen Hammett and I are going to be discussing the Ultimate Income Trader Workshop that we had in Boston and that we're releasing today. So first of all, welcome, Stephen. Say hi to everybody.
Hi, John. Hi, everybody.
Hi. The market is on fire today.
Indeed.
Yeah,
what else is new?
Right. I know, moving right up there. Any of these down moves, you got to buy them for sure.
Right.
But anyway, I have a small slideshow that I'll share with you, and I know Stephen has a slideshow as well that he'll share with you in a little bit. You may be asking, what is Ultimate Income Trader Workshop? Why was it created, and what's in it for you as a trader? Well, one of the challenges that I've seen that many income traders have is that they don't truly understand what they're trading. You know, they might know what the Greeks are, and they might know how to read a price chart, and they may even know how to look at an implied volatility chart, but they don't really have a clue about what to do with it or what it means. Yeah, I often equate this with reading an altimeter on an airplane. For those of you who may not know what an altimeter is, it's a gauge that tells you how high something is, like an airplane, for example. And anyone who can read a gauge could look at an altimeter and tell how high their airplane is. So if an airplane is flying around at 10,000 feet, anyone can look at the altimeter and see clearly that you're flying at 10,000 feet. However, that does not imply that the person knows what the gauge means, because it does not mean that you're 10,000 feet above the ground. It means that you're 10,000 feet above nominal sea level. That being the case, the person may think he's perfectly safe flying along at 10,000 feet, and he may have flown around at 10,000 feet for years without a problem, until one day he's flying along at 10,000 feet, and bam, he crashes into the ground. Well, what the hell happened? A 14,000 foot high mountain is what happened, right? The person reading the gauge may have known how high the plane was, but he didn't know how to put that number in the context of what's going on around him. He thought he knew what he was doing. He had experience working with it very successfully, and this made him overconfident. I mean, why bother looking out the window? My gauge says I'm at 10,000 feet. I'm perfectly fine. Until, of course, you're not, which results in disaster. And so it is with implied volatility. We've got a ton of people out there talking about implied volatility, saying that knowing your implied volatility is the answer. Or sometimes they talk about the Greeks, and they say knowing your second or third or fourth order Greeks is the answer. It'll be like, what? You don't know your second and third order Greeks? Well, no wonder you're having problems. Learn those, and you'll reach the promised land. Hallelujah, there's your promise. Now, the reality is that you or anybody can make a ton of money in options very responsibly simply by looking out the window and observing the landscape without even looking at gauges. I'm talking no Greeks, no analytical graphs, never even knowing what first order Greeks are. Never mind what second and third order Greeks are. So, if you're continue looking for this more advanced stuff and you're not making money, there's a problem there. You have something else going on, right? There's some other issue with your process. So that said, many of us choose to trade in a way where we're relying on Greeks and where we're relying on a T+0 line. And you know, a lot of us might ignore technicals in the news and solely rely on the gauges. Now, when we rely on our gauges, we need to know a few things, right? We first need to know how to read the gauges, and then we have to have a general idea about what the reading means. I think most of us know how to read the gauges. Most of us know that delta is the amount of money you make or lose with a dollar price movement. We know that gamma is the amount by which delta is expected to change over the next dollar of price movement in your asset. Theta is the amount the position theoretically gains or loses in a day. Vega is the amount the position gains or loses with a point of implied volatility change, right? Most of us probably know that. But what many people don't realize is that these numbers are completely theoretical. They describe the result of something else. And for the most part, traders don't have a clue of what creates those results. So for example, I often hear traders say things like, the value of my position changed, which is another way of saying the extrinsic value of my options changed, because the implied volatility's changed. And I've even said that myself in the past, right? But that's not what I mean, because I know that statement is completely backwards, because your options did not change value due to implied volatility. It's the other way around. Implied volatility changed because your options changed value. And there's a huge, huge difference between those two statements. Saying that your implied volatility changed because extrinsic value of the options changed is like saying that I eat too much because I'm fat. No, you don't eat too much because you're fat. It's the other way around. You're fat because you eat too much. You know, being fat's the result. And until I truly understand that that's the case, I'm never going to lose weight. I'm not going to know how. It's the same thing with IV. I can't expect to be able to understand and predict implied volatility by looking at an implied volatility number, because implied volatility is a result, which means if you're depending on implied volatility to do certain things in order for your trade to work out, you'd better understand the forces that determine the implied volatility, because that's the only way to really make meaning out of the number itself. So the thing that actually determines an option's extrinsic value is not implied volatility, and it's not time, and it's not theta. The thing that determines an option's extrinsic value is market demands. The extrinsic value of an option gravitates to the point where the buying and selling demand on that option is neutralized. Period. It doesn't matter how far you are from expiration. It doesn't matter. Nothing else matters. All the Greeks in the applied volatility numbers, all they're doing is they're making an attempt at logically explaining the emotionally driven price of an option. They're a result. They do not create value. So your question should be not what is implied volatility doing, but rather what is determining the buying and selling pressure on this option right now, and what has to happen in order for that to change. So that comes down to two things. It comes down to fear and greed. And if you know anything about fear and greed, you know that they're not logical. They're emotional. What this means is that the Greeks that you're looking at, they're trying to logically explain an emotional behavior. And for those of us who are parents of teenagers, we all know how well that works. My point is being that rather than expecting an option to change value according to its Greeks, realize that Greeks are simply a measurement or the result of buying and selling pressure on an individual option. So in Ultimate Income Trader, our goal is to fully understand what specifically drives option prices at specific strikes. And to do this, we look at the players in the market. What are their roles? How do they think? How much influence do they have over price movement? How much influence do they have over implied volatility? What time frames do they influence? What makes them greedy? What makes them panic? By knowing these things, we can understand why extrinsic value and therefore implied volatility changes. But even better than that, we can look at the implied volatility levels and tell what the major participants in the market, the people who are driving the market, we can tell what they're thinking, which in turn helps us make better trading decisions, especially when it comes to things like implied volatility and things like that. Which brings up a point. why the heck do we care about implied volatility in the first place? Well, one of the things that you should understand about non-directional income trading is that if you're truly trading neutral, in other words, you don't have any in-the-money directional bias, if you're truly neutral, the only reason that we make money as income traders is because the actual price movement in the asset is less than the feared price movement in the direction or directions we're taking on risk over a certain period of time. When a statement like that's true, we make money. When it's false, we can try and compensate for that. In other words, if we were wrong, we can try and compensate for that by making adjustments. But if the movement of the asset far exceeds the perceived risk on entry in a direction we're taking on risk, we're going to lose. Now, one of the things we discuss in the program is the fact that every trade we put on says something. It tells a story. And if you look at it this way, it really helps you understand your trades a little bit better. So your story creates or it defines your winning and losing scenarios with that trade. And believe me, no matter what you think you're trading, it always has a winning and a losing scenario. So an example of that, if I put on a long call, let's say out of the money, and I expect to win the trade, the story or what I'm saying is I believe that the actual upward price movement in the asset is going to exceed or be better than the feared upward price movement in the asset, because that's the only way that I win. If it's less than that, I don't win, right? So unless, of course, that option was deep in the money or something like that, right? In which case you're directional, and that's a different story, right? That's telling another story. But in the case of an out of the money call, that's the story. If I sell a call out of the money and I expect to win, I'm saying that I believe the upward price movement of the asset will be less than the feared price movement, because that's what has to happen in order for me to win. Now, as we get more and more into these complex strategies and we start introducing adjustments, we're doing the exact same thing. We're creating a story of when we're going to win, a story of where we're going to lose. It's just a more complex story, it has more plot twists, and it brings a lot of variables into the story. But it's the same thing. So, for example, if we do a broken wing butterfly and we start with our price outside the tent and we have no upside risk on entry, we're saying something like, well, I'm going to win if the market moves down slowly. In other words, the market moves down, but down less than the feared price movement at the time of entry. And I'm willing to break even if the price sits or moves up. Because if I sat here, pretty much that's what I do. I might gain a little bit outside the tent as things decay, because we know the T+0 line pops out there. But generally, that's what I'm saying. And then maybe I might want to apply an upside adjustment strategy and maybe a downside adjustment strategy. But if it was an upside adjustment strategy, the strategy might say something like, well, I want to make a certain amount if the price sits or continues higher, and I'm willing to bet that the market will not move down or move down even less than I did on entry, because by leaning my position in a manner where I make more money to the upside, or if I lean it in a way where I make money indefinitely to the upside, I am taking on additional downside risk. And I will lose faster if the market comes down if that happens. Those are just the principles and the mechanics of things. It doesn't matter what you're trading, right? Or perhaps I saw a trader who does something that's maybe a bit more complex. What if I'm doing something like this? These are the same trades, by the way. I have two options in different expiration months. I have long options in April, which is closer to expiration. I have some short options in June, which are longer term options. It gives me a T+0 line that looks like this if I fix the expiration graph for the closer date, right? And this is telling us a story, right? We are basically betting that, in this case, the fear in the market or the asset is going to move down less than the fear in the market in trade A, which is our longer term market, right? We have our June market and we have our April market, those two different markets. So I'm basically betting that the actual down movement is less than the feared down movement in month A. But if I'm wrong and we do get a down move, I'm betting that the actual movement far exceeds the fear that was in the market when I entered my long puts. Okay? And if everything works out, that's great. If everything works out and the price just goes up, I'm fine. If the price goes down crazy and it affects my short-term market more than it affects my long-term market, I make money. But there's a losing scenario to this trade, and it's quite nasty. If, on the other hand, I get a volatility shift, in other words, if the downside move in the market is greater than the feared move in the market in my long-term options, but the move does not affect my short-term options. In other words, the fear doesn't escalate in the short-term market, so the market moves down enough so it puts, maybe it's something that's long-term, or maybe the short-term market's already escalated in its fear. If that's the case, I get a down move, and my long-term market starts to freak out, and my short-term market says, well, we kind of expected this. This position gets absolutely crushed and destroyed. So there's a middle ground there. And that's basically the type of story that we're saying by putting on this type of position. So when you look at things in this manner, right, when you look at things in this manner, you get a really great understanding of what has to happen for you to make money, as well as what your risks are as they relate to implied volatility. And if you couple that with the understanding of what drives the extrinsic value of the options, it creates a really in-depth understanding of your positions and your actual risk, what you're actually risking. When most traders look at a trade, they're looking for a set of rules to follow. Maybe they back test the rules, maybe they modify the rules, but in the end, many traders find or make a set of rules, and they hope that what happened in the past is going to continue to happen in the future, so they actually make money, right? Hopefully without getting wiped out. And sometimes it works for a while, but there are three main issues that we have with that type of a thought pattern or a thought process. First is that the exact same situation doesn't repeat itself over and over again. It sort of repeats itself, but it certainly doesn't precisely repeat itself, and it doesn't have to even be similar. The same move that reversed at just the right time in backtesting when you were taking on way too much risk may go the other way this time. The implied volatility shift that happened to occur and made you a boatload of money this time might go the opposite way with the same type of price move and blow your account out. And I say this because I've seen it happen. You see, one of the challenges we have as humans is that we delete, distort, and generalize things. And that's a good thing in a way, because we have to do that in order to survive. Because we have so much information coming at us at any moment that we'd be paralyzed if we didn't delete over 99% of it. So we have to generalize like crazy just to get through life. For example, if we didn't generalize that a certain rectangular shape in a certain part of the room is a door and probably has some sort of handle and it's going to open one way or the other or maybe slide, we'd never get anywhere. I mean, if we had to relearn what a door was every time we came up against an object that was slightly different, what if it was red instead of blue? It's not a door anymore, because you have to generalize just to look at the same shape with a different color and realize it's still a door. So generalizing is a great skill to have. But when we generalize and we assume that just because the price reversed in the past, or that implied volatility reacted one way with a price movement in the past, if we generalize and think it's always going to do that, it can create some really big problems with our trading, especially if you decide to over leverage yourself. I mean, it can be really bad. The second thing is when traders go out and they actually go out and they trade a rule set that they've spent so long developing, they usually don't actually trade it the way they back tested it. And assuming the person back tested the trade properly, which, I mean, that's a whole other subject, right? But assuming it was actually back tested properly, if you don't trade it the way you back tested, you're not doing the same trade. And therefore, even if history does repeat itself, you have to expect a different result. Right? It's not going to be the same. You do something different, you're going to get something different. In which case, I have to question the point of doing the back testing in the first place. And lastly, conditions change, laws change, policies change, technology changes. Something that's worked for years might just stop working. So you need to be able to realize how to recognize that and how to be adaptable to that. Now, one of the things you've probably seen me do if you've been with me for a while, especially in a live event, is to look at a trade, even a trade that's completely new to me, something I've never seen before. And I can pretty much tell with 95% accuracy when that trade is going to do well, when it's going to go poorly, and more importantly, how bad it's going to get when things eventually turn out of favor for that system, whatever it happens to be. Now, I believe we all have superpowers. I know people who are much smarter than I am. I know people who are much better at theory than I am. People who are better at reading market direction. In fact, some of my students are better traders than I am. They all have superpowers, and so do I. I do everything I can do to help them find and master their superpowers. That's one of my powers. But my main superpower, if you don't know what that is knowing the key components needed to make something work and finding out why something doesn't work or why it's going to fail. I can literally look at something I know virtually nothing about, determine the key factors that make it work, and pick out what's wrong. Now, that's a two-edged sword, right? Because everything has problems. And if you're constantly aware of all the problems, it'll paralyze a person. I know, right? Because it happens to me. And my wife is always like, well, why are you always so negative? But it's not that I'm negative. I'm just acutely aware of all the potential flaws that might be happening, which is useful as long as you realize that everything has a defect, everything has a problem, and you're not going to find the perfect thing, right? So if you can realize that and you can keep those defects in proper perspective, you can do really well. But aside from that negative factor, a superpower like this is really cool. When I worked on cars, I could walk by a car and things would just pop into my head. Oh, that's going to be a problem. Oh, it's got a leak in this tire over here. I smell electrical connection. People would say, how do you know that? I could fix anything. I could find anything and fix anything. In fact, by the time I was 18, I was head diagnostic technician at a large BMW dealership. And I had trainees working underneath me before I was 20. When I was in school for computer programming, I had several instances when no one could figure out what was wrong with particular programs. Teachers would look at it for days. I'd come by, ask a few key questions, have it fixed in 20 minutes, even though I had virtually no idea what the program was. And that's the way things happen for me. That's something that comes natural. Essentially, I notice things, I cut through the crap, I look at only what's important, which allows me to pinpoint what can go wrong, ask a few key questions, figure it out, and figure out a fix. It's not always the best fix, it's not always the most simple fix, but it's something that works. Even in cases where I really don't know very much or maybe nothing about the theory behind it. And that's my superpower. So one of the things this allows me to do with trading is to look at any set of trading rules, quickly recognize the key elements that make it work, determine when it's going to do well, when it's going to have problems, and the consequences of those problems. And this is what I want for you. I want you, any of my students, to be able to do this. I don't want you to have to learn a set of rules and have to back test them for 100 years and then hope they work when you go live. I don't want you to see a new trade and wonder if you should be doing that instead of whatever you're doing now. Instead, I want you to get to the point where you can see a trade, you look at whatever the creator's doing or whatever you made up, and then instantly tell with amazing accuracy what has to happen to make it work and what has to happen for it to fail, and what are the consequences when it fails? What are the consequences versus the consequences when it works? I want everybody to be able to do that so that you know if something's worth investigating and spending your time on for your particular trading style. Okay, so those are just some of the aspects that we cover in Ultimate Income Trader. And I probably talked way too long, and I'm going to give this over to Stephen. Stephen, are you there?
Sure.
Hey, I'm going to make you presenter, my friend.
All right. Pass over some of those superpowers while you're at it.
My friend, you have your share of superpowers.
What I wanted to do, or what John had asked us to do, is to, can we come on and give sort of a student or an attendee's perspective on the course? Because, there is a lot of information. This is like double graduate, maybe PhD level stuff. And I don't say that to scare anybody, but this is the kind of stuff that takes lots of practice. It takes time to digest these concepts, but boy, is it powerful. And I'm still in that process, and I'm, that's part of the journey, but, I think there's some value, obviously, in giving you a perspective of somebody who attended the program and is still very much a student of the game. And so I'm going to go over 6 what I call kind of high-level learnings, but I'll go into some detail of what I took away from the program. And so, you know, I kind of want to start with the end in mind with this presentation to say, well, what's the point? Why the ultimate income trader? What's it about? What's the frickin' point? And I don't know where I borrowed this slide from, but this is a slide that John had put up in one of his programs. What is a master trader? You know, he's confident, he's resilient, he's adaptable. That'll be a key word. Trades well enough to support themselves through virtually any market condition. Boy, that's really apropos with what's recently happened, right? We had grinding up markets, 9-handle VIX, straight up to the moon in January, and boom, it changed. And I think John can attest to this. A lot of traders were shaken. They were, you know, looking for different trades. They were questioning themselves. They were, you know, maybe looking for different education services. It really caused them to strategy hop and asset hop and shook things. This is what this program should be able to guard against, to protect you from doing that. And, you know, John says, what for a master trader, what is their secret? And I think part of this program is going to teach you, they learn about markets and not just to trade, the paint by numbers. We're going to learn about the markets, create the story like John said. We're going to learn how option structures actually react. And I think one thing, you know, to build on what John was saying, you know, not only are we looking at our Greek instruments and our models, say an option view or O&E, but we also have to recognize that those don't always tell us the truth, or they don't always have the full picture. And you have to understand the intricacies or the limitations of that software. And that's something that's really powerful. When the model's telling you one thing and the market moves and the result is totally different and you're screaming and yelling at the software, which I think we've all probably done. You know, when you have the skills that you could get out of this program, you'll start to understand and anticipate the shortcomings of that model, and it'll really help your trading.
I think that's very powerful, Stephen, because like I said, the analytical models are, I mean, they're just a model and they make certain assumptions, and you as the trader are the one responsible for determining whether the assumptions the model is making is going to actually come to pass if certain price movements happen.
Right.
Yeah.
And I think that happened a lot last year. You know, the right leg crush was a recurring theme with a lot of people, and you know, the model wasn't picking that up because we were such an abnormal sort of skew market, if you will, and a grinding up market, and it creates problems if you don't really understand what's happening and how you can maybe combat that, so to speak. And then, you know, the last bullet point here I wanted to highlight was a master trader understands there is no holy grail, and that the effectiveness of any system comes and goes. And that includes, you know, all of John's wonderful systems as well. And, you know, certain aspects of them, it's probably more accurate to say, the effectiveness comes and goes. And so we have to be aware of that. And so to really, you know, to master this game, to master your craft, I'm gonna go through sort of the 6 elements that I think that you need to learn, that this program definitely brings to the forefront. And one big central theme is it teaches you how to get in tune with the market, its ebbs and flows and its patterns, not only from an IV perspective and a price action perspective, but from an option markets perspective. And so with that, I think I'll just go through the summary of the 6 lessons.
Awesome.
Or the 6 takeaways. Yeah. So the first, you know, the one that was really obvious to me that I've always felt like was part of the end game, if there is one, in the learning process, is adaptability. You know, getting to a level where no matter what the market throws at you, you can adapt. Okay, you know, when there's bows and arrows coming at you, you might need a shield. If there's something else coming at you, you might need a little bit different protection. Or if the market is just going haywire, you've always got something in your quiver, or your portfolio of strategies or tactics or whatever ready to go. You're adaptable. You know, you can shape shift. It's like water. Water can go around anything, right? It can change form. That's the kind of state you want to be able to get to, or that's at least what we strive to. And I think this program definitely gives you the ability to adapt and be a true adaptable trader. And for me, that's what that means. I think a lot of people say, you got to be adaptable. Well, that can mean a lot of different things. But for me, it means, being able to change and move with the market no matter what it throws at me, so that I have a consistent equity curve. And I may not be trading the same kind of trades and the same kind of structure. I may be all over the place, but at the end of the year, I've got that consistent equity curve that I'm always striving for. And the second learning was, John really kind of drove that home on his part of the presentation, is how do we make money, or what drives that? Where do the gains and losses come from? And I'll go into detail on that in a couple slides later. The third takeaway is this powerful combination, and to me this is probably one of the superpowers, right, is when you combine that understanding of IV skew structures, not just absolute value IV, and not just looking at one IV curve, but the structure across time, horizontally and vertically, and you combine that with some basic technical analysis and charting. I don't think John's ever felt like, you had to know every single indicator of the book, or know, what an bearish engulfing pattern. We're talking about fairly simple, very basic technical analysis. When you combine those two things, bam, that's a superpower. You're on your way to master trader. And that's probably one of the main thrusts of the whole program, is to be able to use that information. And so number 4, I think number 3 on this list leads you to number 4, right? So when you really understand skew to a deeper level, and some basic technical analysis, even some advanced stuff, although I don't think, John, you ever get into indicators and all this other fancy stuff. It's not that hard. I think a lot of people either don't believe in technical analysis and patterns and whatnot, but I would say give it a chance. Check it out first. And when you combine those two together, your mind will open up to all sorts of trade possibilities. For example, a positive vega, and gasp, a negative theta configuration. Yes, those kind of configurations can make money if you're using the skew and your technical analysis in your favor. You can make all kinds of configurations and structures that we usually don't consider. And then number 5, it seems like the first 4 things leads us down a path of complexity. But the big shocker, I think, at kind of the end of the program, John, for me was like, wow, wait a minute. We're kind of saying, yeah, once we get all this high level or this deeper understanding on our belt, we're really moving back to simplicity. Because I think a lot of people tend to associate complexity with higher returns. And as you said in the past, that correlation is not necessarily always the same. And in fact, it could be the opposite.
Yeah, I agree completely. And I see that more and more people getting more and more complex and making less and less money. So,
yeah.
very,
and
very
I think
good
the
point.
simplicity as we'll show, it comes in a different form. It's not necessarily simplicity, say, in the context of a UB1, like where it's just strictly rules-based and you only have 1 or 2 things you're doing. I don't mean simplicity in that way. I mean simplicity over the campaign. And then number 6, once you've kind of got 1 through 5 internalized, it allows you to kind of sit there and lay out the trade plan, and you visualize literally how the 4, 5, 6 different ways, or however many ways that you've planned for, that it's going to play out. And so I'll go in depth on a little bit more on each one of those high levels. And some of it may be a little bit redundant, but I think it's worth talking about. So adaptability, right? So we're moving away from repetitive trade structures, which is pretty much everything that's out there in the market. There's nothing wrong with it. The paint by numbers, we kind of hear that term tossed around. It works great. You have to find something that fits your personality, fits your lifestyle, fits your risk tolerance. That's fine. A lot of those types of trades work. It's just the problems can come when we have market dislocation.
They're an awesome place to start too, right?
Yep.
Right, they're an awesome place to start.
Yeah, you have to.
Numbers. If you're a new trader, that's what you want to do. You want to come in, you want to just get to trade rules, see how they react. Yeah.
No, definitely not a knock on it. I've got a new student I'm working with now. We started out with a bull trade. Now we're moving into the UB1. I said, you have to learn this first before we move you on to the M3 and the X4 or wherever you take your trading. You've got to get your foundational stuff down. But if you are frustrated, or if you feel like you want to take things to the next level, this is how you can move away from sort of the paint by number stuff. This is how we evolve and how we adapt. And, and I don't mean this in a negative way, but this could be one way to think of it, is if you if you do the pay by number trades, you're going to get paid by number results, which is fine. Doesn't matter. But if you take the learnings and get the deeper understanding from this program, I think it really helps to guard against strategy hopping and asset hopping, which is what I think you see every time we have these corrections, or it's not even a correction. It could be just a straight up bull market like we had last year. It causes people to strategy hop and asset hop. And I just think, to me, that's like starting back at ground zero.
Yeah, another thing too.
We've all done it. I've done it.
Right. And another thing too, Stephen, this down move we had in the market, I mean, if you're paying attention to what's going on, that had to be expected.
Had to be expected. And like you and I talked about, it was a big opportunity too.
It's a big opportunity, and it retraced right to the point where it should have retraced for a very strong uptrending market. There's this, there was nothing that really shouldn't have been foreseen, other than the volatility shift may have been a little bit more than we may have expected, but more than normal for multiple reasons. But that's because one of the things we talk about in the program is the sentiment shifts. We had such a severe sentiment. We haven't had a down move in the SPX in 2 freaking years. And you got a market that's exploding to the upside. There's no fear of the downside. Just a normal technical move. If you know basic technical analysis, a normal technical move, you would know that a normal move would have been a move like we haven't seen in 2 years, just to correct back to a normal uptrend. And you could, and if you're not going to protect against that or trade smaller or do something, I mean, I lost money that month too, but I was in much smaller than I normally am, because the market at some point I know what the market should do, and the market wasn't doing what it should do. So that makes me as a trader nervous and causes me to size my positions down.
I was going to say, and or put protect or play it out a little bit further and say, when this correction comes and it's going to come down to this particular area, what can I do as far as new trades?
Right. Playing in advance, I love it.
Play in advance to say, I'm not going to get out of the trade I'm in now, because it may not correct now. It hasn't corrected in 2 years, like you said. But in the case that it does, I've already got a plan in place on how to protect this current trade. And actually, I might protect it now, because like you said, there were clues in the market that said this was coming. And, January was giving lots of clues. I mean, just from a simple standpoint, the RVX was going up while the Russell was screaming higher. Well, volatility going up when the market's going up is abnormal status. So, that right there, so you have a plan in place to deal with the current trade, but you say, when that correction comes, what am I going to do to take advantage of it? And the ultimate income trader is where that comes into play, is to help you get prepared to take advantage of opportunity, not sit there and play defense all day long. So just to finish out this slide, the first thing you have to do when you're in an adaptability mode and not just strict rules-based or even some concept-based trade station, what market am I in? And it's more than just saying, I'm on a bullish and a bearish market, but it's taking technical analysis, IV, and the skew charts, and kind of having a multiple dimensional look and say, now what market am I in? Well, I'm in a bull market, grinding market, but I'm also in one where the VIX is at a 30-year low. I'm in an abnormal bull market. I think you could probably characterize it as that. And that there's a correction coming. It's like point number 3, build the story by using more than just, well, it's bullish, it's bearish. Well, but we have access to more context, right? IV, skew, build the story. And then that helps us to adapt our trades.
Nice.
And so this one is the bullet point number 2. This is the one that I thought was really great when John's in the program talking about it. He's like, it's almost like you kind of want to say, no, you guys all got it wrong. Not the students, but, the educated universe out there, right? And so I think it's great when you hear, we're theta traders. What do we think? We trade theta, and I'm like, yeah, well, there's not the theta gremlin who sneaks into your account at night and he sticks that theta number into your account. And, and he especially puts 2 deposits in your account over the weekend, right? Because you're positive theta trader, he's sticking that money in your account. You're making that money. No.
You know what a really good example of that is, Stephen, is that, and I noticed this because I put one of these on. I put on a negative delta SPX butterfly, broken wing butterfly back in, I don't know, mid-January maybe. And the price went up, and it got crushed. But theoretically, it was like over a month since I had put it on. It was either late December or early January, but it was, I think, so it must have been late December. It was over a month I had this trade on. And it was a negative delta butterfly. And if you looked at the T+0 line, it was developing a nice little hump in it, and everything was going to be perfect. Well, the market pulled back right through that butterfly, and by the time it hit the center of the butterfly, despite a month going by and my theta working for me for how long? I don't know.
Right.
Despite that, the thing was down an incredible amount of money.
Right.
By the time it got back there. So
Yeah. And I mean,
so what did the Greeks mean?
right,
Like,
exactly.
crap.
Exactly. If you didn't have the, further, the trader who's just starting out, or maybe even some intermediates, that could cause a lot of angst. And it's not only, the gain loss impact, but it's the mental capital impact, right? You're like for me, I would kind of get wrapped around why is this happening? What the hell is going on? Why is the T+0 line under zero on positive theta? And I've had this thing for 30 days. Why? Well, ultimate income trader. It's going to provide you the tools to be able to answer those questions and get in tune with the market and understand. You had I forget if it's a community coaching session or not, maybe it was a question. It's somebody says, we're trading uncertainty, right? And uncertainty is expressed as implied volatility. And one of our members, Bob Dobrin, he asked a question or the statement. He says, we get paid more when there's greater uncertainty. And another way to say that, which is what you were saying earlier, John, is, we get paid when realized or historical volatility turns out to be less than implied volatility during the campaign. That's how we make money. And so, ultimately, in the day, we're trading emotions, and specifically fear and greed. And I've got I call it a thought pyramid, to kind of explain that. And maybe this, starting at the base of this pyramid, is maybe kind of how some of us have evolved our understanding of what we're doing. Because I know we all you see that first education site, you said, sell premium, iron condors, credit spreads, you make $100 a week, you'll be Goldman Sachs in 6 months. So, that's the way we kind of think of what we do, is what income trading is. You're selling premium, and then you kind of evolve and you think, well, no, okay, it's theta decay. That's what we're really doing. Sure, okay, that's fine. And then you kind of evolve your thinking again to, well, it's implied volatility is what it is. And this is kind of where the big jump, or you'd be surprised how many people don't really understand, is what was like what you were saying, what's driving implied volatility, which is really an output number, is demand. It's demand for those options. And what drives demand for options or a particular strike is this collective emotions of the market, because that's all the market is. A price chart is just an expression of the collective emotions of the market participants. It's not the discounted cash flows or dividend model of all the companies out there, and we throw it on a chart. A lot of people still believe that it's all about PE ratios and price multiples. I mean, it's like, what are you thinking? It's emotion. I mean, somewhere in there, the market is based on fundamentals to a certain extent, but was today based on fundamentals? I don't know. I think there's probably a lot of emotion, and people getting caught in the wrong place. And fear and greed, as collective emotions, come in different forms, right? So there's fear of missing out, which is probably what we've seen a lot of in the last few years. And then there's fear of, losing money, losing your capital. And then there's greed. And that's pretty much it. That's what you're trading. And, the mathematical kind of way to express it is sort of right here, the way I think of it. Whenever the historical is ends up being less than the implied, then we're winners. And like you said earlier, then maybe not so much. So I think, that's important to understand what's driving this and how we stitch this together with the rest of the concepts.
Right. And we just had some comments. Historical volatility has, since early February has been higher than implied volatility, is what Andrew said.
Yeah.
What happens when it switches? Well, the thing is, if your volatility gets to the point where the feared price movement is less than the actual price movement in the markets, our trades don't work anymore. Selling premium does not work anymore because you're not going to get paid anything to sell it.
Right.
You're much better off buying premium at that point.
Right.
Because
Which
the market's moving, and it's moving more than you get paid for. Right?
Yeah. Which kind of boils down to what I was saying earlier. Open your minds to trade possibilities to take advantage of a change in the environment, instead of just saying, well, all I've got is negative vega, positive theta trades. Well, like you just said, those aren't always going to work, but other things can work. And so this is the sort of superpower combination, right? A deeper understanding of the IV skew and technical analysis. I mean, that combination is pretty incredible. And I have on here a comment that 3 times your returns, if you say your base returns is a M3 concept trade,
Mhm.
whatever, 5 to 10% on $50,000 capital.
Right.
Applying this understanding and this kind of these techniques, I mean, 4x, 5x times the returns is very possible without increased risk and planned capital. That's kind of the takeaway, right? I mean, that's what you take off the slide and go, well, I need to check this thing out. I mean, making more higher returns with the same risk with just a deeper level of understanding and some trade planning is what it's really all about.
Right, but we're not doing the same thing every month,
Right.
We're taking a lot of different things into consideration, not just technical analysis, not just volatility, and not just the news, but how the three are interacting with each other.
Yeah.
As to where our opportunity is in the market. Yeah.
Right, and that's a good segue. That sort of speaks to alignment. Becoming aligned with the market and looking at things kind of in a 3D manner, like you just said. Not only price action, not only IV skew, but across expirations. Not only the T+0 line, but maybe even another dimension, butterfly pricing, tracking it, and then across expirations. You take all that together, and you're building a story, and you're getting in alignment with the market, and you're prepared for what may be coming down the road.
Yeah.
And like I said here, understanding all these kind of things gives you a deeper sense of how that fear and greed, which drives option prices and applicability, how that's being allocated.
Right. And it's very realistic, and I think we also talk a lot about the sentiment of the market and just understanding what that is at any given time.
Right, and we kind of always think of it in kind of silos or one dimension, right? We can all look at a price chart and say, yeah, well, we're in a bullish market and higher highs and higher lows, or and then we say, well, then there's the IV, and I kind of know a skew chart, and then then the other day I was looking at T+0 line. Pull all that together. I mean, it's all kind of already in us. We all are kind of, a lot of us intermediate and advanced traders, we've always kind of seen that, but this helps you really wrap all that together into actionable items, and building a new trade. And so I think that's the jump that this program helps people make.
Awesome.
Okay, so, okay, great. I understand the IV skew, and I'm an adaptable trader. I've got a deeper understanding. Now how does this help my business, my trading business, my trading plan? We understand that currently the big IV shifts or major transitions really hurt our trades. So, can we step out away from those constraints? Can we break out from that kind of thinking? Because I think, what we do when we asset hop and we strategy hop is we're still just going to a negative vega, positive theta trade. When we have a big shift, you're not really changing anything. You're kind of avoiding a condition that happened now, rather than you're not in alignment. You know what I'm saying? Like, people will adjust their trade because they're feeling pain because of a certain market dynamic, and then they fix that part, but they haven't really. They're still not in alignment with the market.
Right. Yeah. I know completely what you mean.
You're not really fixing anything. You're just kind of dodging the problem. And you made this comment. We reviewed all sorts of different trades, and it was like, at the end of the day, the tent behind the money income trades, they're kind of all the same, just repackaged and renamed. And I'm generally speaking, and again, not a negative, but we have to understand that all these trades are sort of basically the same in a lot of ways. So they definitely have a lot of the main characteristics the same. So you're not going to just put a name on it and change the adjustment strategy, and now it's a totally different trade that's adapted to this new market. Not really. It's not going to give you that kind of an outcome. When you have that understanding, again, you say, can I go away from this defensive mindset and be offensive? And I think you brought that up the other day, John, in one of our presentations, and that's where another kind of giant takeaway is from this program is, how can I stop being in a passive mode oh, the market's gone up. I've got to roll up. Ah, crap, that takes an hour. I'd rather just do verticals. It's that kind of thing. That's a defensive mindset. And there's nothing wrong with that.
Yeah,
but
you can
is
trade
there a
that
way can we go offensive? Yeah,
Exactly. And I think we all drift to this mindset naturally. I think that's what's been going to us, and we've seen it to the extreme lately with these crazy hedge trades, right? So you tend to drift that way, and I find myself drifting that way mainly because, partially because, I mean, I let myself do it, but partially because basically a lot of the students want that. So a lot of the stuff we've been having lately is broken wing butterfly, broken wing butterfly, broken wing butterfly, because that's everybody's trying to gravitate towards that type of a trade right now. And you're right, it's very, very defensive. And by the way, they are pretty much all the same thing, just repackaged with slightly different adjustment strategies, or in some cases, just somebody who just does stuff at random. They throw a broken wing butterfly on and just kind of does stuff at random to try and make money. But we do gravitate towards that. And one of the things that hit me is one of my students from doing this exercise, and it was Wayne, he comes out and he says, well, we are traders, aren't we? What's the difference between a trader and someone who trades? I mean, someone who trades sticks on a broken wing butterfly and hopes it works out, or has a fixed set of strategies. There's no artistry in that, and you can only expect a certain amount of results from that, and you can't really expect to be varying to different market conditions from doing that. A real trader is going to come in. They're going to be aware of the landscape. They're going to know what's going on, in all the areas you were talking about, and they're going to make a judgment as to where the best opportunity is, and they're going to trade offensively. They're going to trade to make money. They don't trade to not lose. I mean, a true trader, I mean, yes, you have to control your risk, of course, but your primary objective here is to make money. If your primary objective is not to lose, you can't expect to make that much.
Right. And that's a great segue, because one of the culmination of the program is John had us all break up into work groups and small teams, and he gave us a market scenario, a real one in the past, and he just says, go for it. Do your trade planning, craft a trade, tell me what you would do and how this trade will play out. And our peak team, I'm going to have to pat ourselves on the back. I thought we were unique in a lot of ways, and I want to give a big hat tip to the team, and it was Susan Fife, Ed Costa, and our trade designer, Wayne Klump. And we came up with an M21 style trade, which required some trade planning up front, a lot of hard work up front, which Susan was really, really good about, and the rest of us were marveled at her ability to run through that stuff so fast. And we developed a positive, negative theta trade in the class. And in the program, John does one-on-one reviews with, I think there were 4 teams, right, John, or were there 5?
There were actually 3 that we did reviews on.
3 reviews, and he just gives feedback, and it was a really amazing experience to kind of really, it was the whole open your mind up thing for me, and it was an aha. And so, this last quarter, we're in a straight up market. I did my trade planning, took some live money. It was basically based on that pink team strategy, and I made 28% return on capital.
Nice.
And so, to me, that was just like, what? No, not only did I pay for the course, but it was just like, holy crap. And I'm looking at the market and the option configurations and the structures and the adjustments in a totally different way. And, now I've got another way to approach the market. And I actually have added this trade to my portfolio of strategies. And so, that's what you could do when you pull all this together. And if you want a sneak peek of that trade, it's in the program.
That is. That's right. Yeah, because you guys went over it. Nice. Yeah.
Yeah. And we go over it in detail. So, to me, I think that's really where the rubber meets the road.
We spent well over an hour going over the setup.
Oh yeah.
What behind it, and how it went. Yeah. Nice.
And I'll just kind of speak to this slide. I'm not going to go bullet point, but as far as like that experience with that trade we did, all the hard work was done up front. There was some technical analysis and charting that we do. John provides a spreadsheet for you to do. You go through all that once, and you kind of have your technical analysis plan forever going forward. You just kind of fill it in for current or recent activities. And we just plan out the trade. We crafted the trade. If it goes here, then we're going to do X. If it goes here, we're going to do Y. And all the hard work is done up front. And that's where I come back and say, well, once the trade is on and we're in the campaign, it's simple. I'm not kind of wondering. I'm not just concept trading. I'm kind of executing. I mean, sure, you might have something in your plan and how you're going to deviate from it, but it's kind of more in the sense of let the trade ripen. Let the trade work for you instead of, kind of the other way, what we're sort of used to. And when I say simplicity, that's kind of what I mean. You've built your probability map of how the trade's going to unfold, and you just sort of let it happen. That doesn't mean I'm not adjusting or I'm not taking action. It means that, every day we're not doing some incremental thing. We've already sort of planned for all that. It's sort of a wider look. And that kind of leads me to this last slide, John, of visualization, right? So once you've done all the hard work up front of the trade planning and how this is going to play out, you just kind of think of it, visualize it. It's like a golfer, right? Before they kind of close their eyes, you'll see some golfers, they'll close their eyes and they're going through that mental exercise in their mind. I know, John, you've probably got a little bit more advanced analogies of this, but they think of the shot, like the variables, what's the distance, what's the wind, what direction is it coming from, they take all those variables into consideration and they think, what's the trajectory, that I want of this shot, what's the shot shape. Once they have that in their mind, then they go execute the shot. And it's very similar with this. All your trading is done up front, like I said, and you just dance with the market. You're in alignment with the market. It's already planned out. It doesn't mean everything is going to work out as a profit, but it means that you've stacked the odds in your favor even more.
Right. I think that's an important point you brought out. I mean, yes, we increase our odds even more because we're taking the landscape into consideration, and that's extremely powerful. But at the same time, things don't go as planned. Right? We make these plans. Things don't go exactly as planned. But what we do know is, like, when we plan out a trade, is we have indicators where we're going to change our opinion. So we have spots or areas or things that might happen that might change our opinion. And we know that ahead of time going in. And we play those out. And the visualization plays a really strong part in that. In other words, I'm going to take my trade and I'm not just going to visualize it going perfectly. I mean, that doesn't really do me any good. I mean, it gives me an idea of how it might go. But realistically, I need to visualize it, all the scenarios that may play out, and make an estimation of how much my trade's going to be drawn down and all this other stuff. Like I said, one of the things that I can do, and I've told people this for a long time, is I could take a bearish butterfly at any given time. You tell me the entry price in Delta, and then tell me the market's here. This is the range the market's been in, and the market's here on this date in the future, and I can tell you within a very, very surprisingly accurate number what my profit and loss is. I can tell you what my delta is. I can tell you everything about that trade and how it's going to be, the position it's going to be in. I can tell you what my feelings of that trade are going to be about.
Right.
So you should be able to do that for yourself. When you set your trade up, yeah, you play out the right process. This is what I think is going to happen, but also play out every other process you can think of. In other words, by the time you actually put this trade on, you should have done it in your mind like 500 times. And the good thing is you can do it really quickly in your mind. Right? And that you know all the scenarios, you make your best guess at how far down you'll be. That way, when it actually happens and you watch it play out, you can get feedback from that and say, oh, I was wrong when I was down this much. I was wrong. I was actually up money. Why was I actually up money? Kind of get an idea surrounding of, compare what you thought would happen with what actually happened and figure out the reason for the difference and use that the next time to more accurately predict what your position is going to do the next time we do it. And it's just a cycle that continually gets you better and better and better at doing it. And when you practice that much, like a lot of traders, they put on 12 trades a year. You don't learn shit from doing 12 trades a year.
Right.
You do something 12 times where the circumstances are different every single time, or if they're the same, you really didn't do anything because you did the same trade 12 times. So you don't learn anything. You only learn something when you look at all the different things that would have happened and you do it. Now, I might, somebody might do a trade for a year and do it 12 times. I might do a trade 12 times and do it 3,000 times. So I have that much more learning in I learned that much faster. How do you learn so fast? Well, that's how you learn fast.
Right.
You play the scenarios out.
Yeah, like the trade that I put on, I guess we could call it a pink team trade that I put on live. It was partially an experiment, right? Let's put this to the test, but I made much more money on that trade than any other trade that I've got, but I learned so much more, just like you just said, than any other trade, because it was a new experience. Obviously, it was a totally different configuration, but I picked up so much more just from that one campaign that I'm going to fit in the next campaign to make it better. It's like you said, it's that snowball of knowledge, right? It gets better and better and better as you keep going through new iterations of the trade.
Right. I mean, when you first do this, you're going to suck. I'll put it right out there. Right.
Yeah.
Because it's completely new. Your emotional bias is going to be in. But if you stick with it, we do things with people, especially when we start doing like the M21 program, people start doing that and they say, oh, this doesn't work because my performance actually decreased. And I said, yeah, you're doing something new. Your performance is going to decrease. But the people who stick with it are they're killing it. So the same thing here. You got to stick with it until you get this stuff down, and then so you can be killing it.
Yep. And it takes time. I mean, it's like you said, I by no means am I, a master trader or feel like I have all these things down to a T. It's a process, but I know enough now to know the power in it and where it can take my trading, if that's a fit, and if that's where I want to take it. And, for me, I think the more you can learn, the better your trading is. Even if you stay with simplistic trades, it can even make those trades easier.
Yeah, I mean, if you're doing something as simple as a bull trade, if you know what's going on in the market, you might have times you might want to stay out of it.
Right.
Certainly with a bearish butterfly, there's times you don't want to be in the market.
Or size it up or size it down.
Yeah, exactly right. Yeah, size to your confidence, as they say, so that you have more room to fool around with stuff. And like we both said, there are times you are going to be wrong with the market. One of the things I do with a bearish butterfly all the time is I'll put a bearish butterfly on when I think I'm at a resistance level, but my intent is never to get fully scaled into a bearish butterfly and lose, $30,000 on $50,000. My intent is if the market doesn't do what I expect it to do, I get out and I do something else.
Right. You're dancing with the market.
Yeah. Yeah, so it should have been bearish here, but hey, it's not. It's like the Russell thing. My thought on the Russell last Monday was it was probably going to come up to resistance and it was probably going to range sideways. Well, the day that broke out, the story changed. That's an instant flip in sentiment. That shouldn't have happened, and I know that shouldn't have happened. That being the case, I'm full on bullish at that point. Because
you didn't get married to your initial thoughts.
No, even if my initial plan was put on a bearish butterfly, it looks like I'm on top of the market. I'm not married to that, because if I'm looking at the technicals and I'm looking at my volatility, and if I see a breakout with a certain volatility shift in the markets, I mean, and I look at the cross index, we do cross index analysis. I look at all the other indexes and what they're doing, and if I think that thing's going to fly, I mean, my opinion changes on a second. Mm-hmm. I don't need to stay with that opinion. It doesn't serve me anymore. So, and if I'm 1/3 in a bearish butterfly, that's a very safe entry. Yeah. So it's,
and I think, John, and the other big benefit, and it's, like I said, it's not totally there yet, but it will be, is it's the emotional benefits, the mental benefits. So like days like today, can cause a little angst for, most of our traditional trades in terms of, it's a little bit more work and you got to do this, you got to do that, and it's going to vary from certain people, but when you're really in tune with the market, you're just like you said, you just flip sentiment, you change your trade or you change your configuration. It's not a big deal. It's like, I visualize that. That's fine. I'm not married to it. I'm in alignment. You do what you want to do, and I'm aligned with you. And I think that can help reduce some of the angst that builds up when the market, has these sort of extreme moves one way or the other. And that, anytime we can reduce or soothe or help our mental capital or psychological state, I think it brings nothing but benefits.
What else helps it too, is the fact you've already played this out in your head.
Yeah, right. It's not a surprise.
Right. In other words, if this happens to me, if I'm a bearish butterfly or whatever, and the market breaks out like this, and we get this real big extended move, especially like the election thing, I've already played that scenario in my head. I can say that hey, the Russell's only ever gone 160 points before it runs sideways or backs off for a certain period of time. I can say that, and I can make a trade plan for that, and it's just extremely high probability because the market's never done anything more than that. It's probably not going to happen. I mean, there's a very, it takes my high probability trade and jacks it up even a higher probability. But there is that 1 or 2% chance that, hey, it may do something the market's never done before. And I need to play that scenario out in my head. It's not it's going to go to 160 and it will retrace. It's going to go to 160, and then if I happen to be at an important resistance point, maybe it's going to break out 30 points at that point, right? Mm-hmm. So I have to already play that scenario out and realize that this may happen, pretty much guesstimate the best I can at my loss, and be okay with that. Otherwise, I can't trade the trade because by the time I get up there, I'm going to be so nervous at that point, I'm not going to be able to hold the position.
Right.
Right, I'm going to do the low probability thing and flatten out, and then the market's going to come down.
Right.
Right. So that's just an example of emotions getting the best of you at that point. You're playing out the perfect trade, but you find out when you're sitting there, scaled in 3/3 that you can't hold that kind of delta for 3 days.
Right. And John, I just want to make the point. The end game of this program is not so that you'll configure a brand new trade like we did with the pink team. That's not necessary. That's just one conclusion. I think for the majority of people, it's how can I take what I have now and improve it and further customize it to me and getting in tune with the market better. I mean, you don't have to come up with a brand new trade, a positive vega, negative theta, but you use this stuff right now to improve what you got.
But there's certainly times in the market where being positive vega, negative vega is very beneficial.
No, I mean, for me, I mean, that's, I just didn't want, the conclusion to be, well, this is about how you can create your own trade. Yes, it is a pathway to creating new trades, which I think is good.
You create your own trade every month, really.
Right?
Yeah.
You could improve what you have, or you can create something totally new and throw that into your portfolio of strategies. And when the market presents a certain scenario, you'll know what to pull out of the bag.
Yeah, exactly. So let's see. I have a question, and I'm trying to read it and make sense of it. So see if you can understand this, Stephen. Maybe just how can we as retail traders, having limited resources and tools, decompose the attribute to our profit and loss among direction, time decay, IV drivers via delta, theta, and vega, P&L, so one knows what's actually contributing to the net composite profit and loss? In a nutshell, what does that say?
Well, to me, it's sort of this: what's driving the gains and losses in a complex option position?
Right.
Assuming if he's asking what's the dominant Greek, I mean, that depends on the situation, right? It depends on context.
Well, Greeks are results, so they're results of fear and greed. So if you understand the fear and greed of the drivers of the market, in other words, the major people who are buying and selling stuff in the market, if you understand that and what they're doing, like we talk about, what's the psychology of, the big money investor? What's the psychology of this, and what are they trying to do, and how do they usually try to take advantage of you? That type of stuff. And when you know or have a good idea what they're doing, and you can get an idea of what they're thinking just simply through a volatility chart. If you look at charts regularly, you'll notice when it's unusual for the technical situation, right?
I was going to say that's a great point, John, because it's been demonstrated in the past. The market likes to fake us out, right? The look above and fail, or the snap and crack, or the look below and fail, and you can sometimes see that in your T+0 line before it happens. Oh, there's a little change in my T+0 line. Maybe it's showing up in the skew, and now I can see what these big players may be trying to do to the market, and I can prepare for that.
Right. And we talk about whether the fear and greed and how to tell whether it's in a short-term market or a long-term market, and whether long-term players are not going to get. I mean, if you're a long-term player and something like February happens, I mean, you're not all that concerned about it. I mean, it's just a normal correction in the market. I mean, so the options market, and say, this September isn't really going to give a crap about what, that little move that happened in February. which is a little move relative to what it usually is, but the short-term market's going to freaking freak out, right? Because they don't have much time to deal with it. So the short-term traders are freaking out, but the long-term guys are just say, hey, this is a buying opportunity. And we saw that because the buying came into the market again, as it has been doing. So doing that is helpful. Go ahead.
Yeah, I was going to say, at no point was, from a technical standpoint, from at least a weekly time frame, was the bullish case ever really at risk.
No, not at all. I mean, all we did is retest a very steep trend line.
Right. I was like, okay, well, that, like you say, that was expected. But when you're in the moment and volatility products are blowing up, it feels like, oh my gosh, is this the big reversal that we're having? And it's easy to fall into that, when you're in the fire.
It is. But, in one context, you should have known a move that size was going to cause a panic in the short-term market. And again, a normal correction size move. So, but anyway, so, I think they're asking, he says, I think they're asking how to do P&L attribution. I don't even know what that means. Like I said, some people have superpowers. That word is not mine. I'm not a fancy college person.
Yeah, I mean, if they're saying, he's trying to say what's driving, what aspect can we attribute to what's driving the P&L? And to me, it's just the emotions, man. I mean, don't overcomplicate.
Emotions are always driving your P&L.
Yeah.
Right? If you do a condor when everybody's freaked out and then they calm down, you make a lot of money.
Mm-hmm.
Right?
And emotions can be subtle, right? That we just saw, we saw extreme emotions on both sides. There was extreme emotion to the upside in January, and then you saw extreme short-term emotion to the downside in February. But every other month of the year, there's still emotion. It's just subtle.
Right. So, this is, when I try to understand something, I always go to the extremes. Yeah. And if you want to know the extremes of selling options premium, and theta and how theta works, or whether it's actually theta or fear or what it is, I could say, what if I told you that we had an April 30 expiration option, and there was absolutely no chance of the market moving a single penny for till that time. Mm-hmm. There was no fear of that. Nobody thought the market was going to go up. Nobody was afraid the market was going to go down. There was absolutely no fear. How much time premium is in that option?
None.
Nothing.
None.
Not a single penny, because there's no fear or greed associated with that option, right? Maybe you can say, well, there's an interest rate thing, right? Very, very minute, tiny amount, right? Maybe there's a dividend, very, very minute. I mean, you can bring in these crazy things. But the reality is there's not a penny of extrinsic value in that option because there's no fear, there's no greed behind it. All this stuff is your theta, your implied volatility, all those numbers are something that's made up for the purpose of creating a model. And they're readings of the results of the price of the option that's driven by fear and greed. So when you come right down to it, virtually all your profit is derived from fear and greed, right? That's the bottom line. And you can measure it via your theta number, via your volatility number, via everything else. But ultimately, it's the fear and greed that's making those profits. One other question here that we have quickly, and then I guess we'll close up. Let's see if we have more to say, Stephen. But what psychological content is in the course? I will make a comment on that, and I'll let you make a comment on that, Stephen. All my more advanced level classes, I sprinkle psychological lessons throughout the class. So realistically, I try to make everything about psychology. There's a lot of psychology relative to what the participants in the market are thinking. There's a lot of psychology as to how you're trading. And there's a lot of psychology going on when we start actually doing the real-time examples that we're doing, right? And I sprinkle it in throughout the program. That said, I don't remember specifically if there was anything that stood out from a psychology standpoint, Stephen. Maybe you.
I think it was subtle. And one thing I could point to that was in one of my learnings was this whole open up your mind. I mean, that's a psychological thing because I didn't realize, at least, and I'm just speaking for me, that I had these sort of invisible constraints. You know, it's got to be negative vega, got to be positive theta, got to kind of lean at neutral. I had that constraint in my mind, and that caused me a certain level of angst. And now I'm able to sort of banish that, because I know that I can do a totally different configuration, or I can take that configuration and, you know, dance with the market or adapt in a way that helps me psychologically, and I don't get as concerned, or I don't get as worried, or you don't, you know, slam your fist in the ground and say, oh, you know, this is going to be a flat month. Crap, I've only got 12 trades. Got to really get it going next month. Maybe I should increase size. And you could really get out of control with your emotions. So I think in a subtle way, or kind of a backdoor way, you know, open up your mind to all this understanding and what the possibilities are. It sort of eases the psychology.
Yeah, you know, those are excellent points. And I think also in the program we talk a lot about the psychology. I don't know if I talk about so much stuff I don't really remember, but I think we also talk about the psychology basically of doing trades and having them work out for a long time, and then getting overconfident and taking on too much risk to one side or the other. Yeah.
Yeah, there's John really drills down deep in a lot of these concepts. So, I mean, there's a lot to unpack, but, you know, there's lots of gold in there.
Awesome. All right. So what I'll do is I'll take this over. I'm often asked, you know, who is the ultimate income trader designed for? It's not for a newbie. Okay. If you're just starting to learn complex option spreads, I mean, find some rule sets, practice, focus in on how the options react, and just do that for a while. It's also not for you if your strategy is to put on and hope. You know, if you say, I'm going to put on this trade every single month, no matter what, I'm going to ignore the market, I'm just going to hope that it works out. Again, that's not for you. However, if you're trading serious money in complex option spreads, or you want to modify income trades through volatility analysis, or through technical analysis, or through news analysis, or if you want to add, you know, subjectivity in any way to your trading, then this is the type of program that would be great for you. If you're someone who wants to drastically improve your understanding of any income strategy, in other words, maybe you do want to trade rule-based, but you really want to get a thorough understanding for how it works, doesn't matter what it is, you know, whether it be rule-based or subjective, then again, this is for you, regardless of the type of income strategy. As long as it's an income strategy, it's not a straight directional thing, right? In the program, we cover factors that drive the extrinsic value of options, therefore the implied volatility of options. We discuss the players in the market, their hopes, their fears, their dreams, their desires, and how that drives prices. We dive into technical analysis, implied volatility analysis. We look at news and how they interact with each other to reveal what the combination of the factors mean. And, you know, it's all about taking your trading to the next level by recognizing and adapting to change, noticing what's happening in the landscape, and utilizing the information to truly put probabilities in your favor. Right? We want you to be able to better take advantage of opportunity, to appropriately control your risk, and become a better trader. So the program actually includes, I have a 4-part technical analysis primer, which some of you may have actually seen before. It's similar to some of the other technical analysis courses that I have. That's included with this. It's a recording of a live 2-day seminar and a workshop where we cover you know, why income trading works. We do in-depth lessons on implied volatility, what it is, how it works, the psychology of the market, who are the major market participants, how do they think. We talk about the Greeks, how they're affected by implied volatility. I mean, most people don't know that all the other Greeks change when implied volatility changes, right? How to predict changes in implied volatility, how implied volatility affects the reliability of analytical model predictions. I mean, if you get one thing out of this course, just being able to better read or understand your analytical model is a really good thing that you can do. We talk about, you know, what's the options skew telling you. We talk about adapting to change, properly identifying risk. We have a section on negotiating orders and trade execution. We have comprehensive process for analyzing the market. We have a process for knowing market psychology based on horizontal and vertical implied volatility skews and comparing that to technicals and the news that happens to be around at the current time. Analyzing the market through cross-index analysis on multiple timeframes, trade planning, customizing trade entries, exits, and adjustments based on charting, implied volatility, and news considerations. We have experiences, trades, and advice from some of the top students. You know, we interact within the workshops and we talk to people, and you get advice from some really, really great traders. Then we have our market analysis and trade planning workshop. We're doing 3 mission debriefs. You can learn how each team analyzed the market. You can notice how they developed a plan to trade to their objectives. You can analyze their psychology, and you can discover the results of their efforts. There's a ton of exciting content in the course, and it's designed to help you adapt to the market regardless of the type of trading you do. So what we're doing here is we are doing an introduction to this. We're releasing it to the public today, and it's going to be normally at $19.95. For non-member and basic members, we're giving them $50 off. For $19.45, premium members, $18.70, and the premium plus members, if you're a premium plus member, we're going to be doing it for $16.95. And if you are a non-member and you want to figure out where to get this, you can come to our main website, go under programs. It's actually under Learn SPX Income Trades, and it's Ultimate Income Trader Workshop, and you can go here. If you are a member, a Premium Plus or a Premium member, then this will go, you'll want to go to in the community, sign into the community so that you can get the right page and go into your discounts page. For example, your premium discount here, premium members, and then we have for our Premium Plus members. So that's how you get a hold of that. And I don't know, you have any last comments, Stephen?
No, I would just say, at the end of the day, this program, it's the ultimate. It pulls it all together.
It does pull a lot together. I just got a question. Is it similar to the M21 program? And in a way, it has some similarities to the M21 program because my market, we did the M21 program when? 2015 maybe?
15 or 14, yeah.
14, and my market, in other words, this is not in the context of the M3, the bearish butterfly, and the rock trade. That's what the M21 is. It kind of does it in that. And the M21 talks mainly about technical analysis and my process for doing technical analysis. All that is included in this class, but it's been updated from another 3 years of experience or 4 years of experience, however long it's been. And we're also taking into account news and volatility analysis also when we do that type of stuff. And there's a lot of extra content too. I mean, you've been through both classes too. Right?
Yeah, I mean, the big difference is the added component is it kind of takes M21 and it adds IV and IV skew. So it's kind of like that third dimension that I talked about, and not only the pricing and the T plus line, it brings in more variables than there's just in the M21. It brings in all the variables. And you find that all in this program.
Plus, the trade plans we put together are they're non-restricted. They can be broken like butterflies. They can be anything, right? They can be you can be under the 10, you can be outside the 10, you can be negative theta, you can be positive vega. We talk about, different ways to adjust stuff depending on how volatility is and all kinds of stuff like that. So lots of cool stuff. All right. Well, thank you. And I appreciate everybody spending the time with us. Thank you, Stephen, for coming on and sharing your thoughts.
Yeah, thank you.
And, happy trading, everybody. And we will talk to you soon.